In this video, I'm going to share with you a secret. You don't have to have superhuman intelligence to know how to invest. In fact, investing doesn't have to be hard at all. If you're brand new to investing, the sheer volume of jargon that's thrown at you is the equivalent of being asked to count how many fish there are in the sea. But don't worry, my friend, this is where I step in. So my name is Rebecca, and I've been working in the finance industry for over a decade now. And my job is to show you everything that I know. So let's start at the very beginning. Why have I chosen now to impart this knowledge with you? And the reason? Because after undertaking my own research, I found that over 99% of the YouTube videos on the platform regarding investing all relate to the US stock market, so a lot of it is not relevant to the UK market at all. So being based in the UK makes it just that much more difficult to understand the terminology that's thrown out by the US market. For instance, our equivalent of the S&P 500 is the FTSE 100. They have the Form 10K required by the SEC, or US Securities and Exchange Commissions, whereas we have the confirmation statement, formerly known as the annual return, or AR01. Still with me? Good. So grab a pen and paper and let's begin. Now, there are a lot of different types of investments that you can make in the UK, some of which include but are not limited to stocks, bonds, investment funds, bank products, options, annuities, retirement, savings, alternative and complex products, cryptocurrencies, commodity funds, security futures, and insurance. But to keep this first video really simple, I'm only going to touch on bonds, stocks, and savings. So let's start with bonds. So what are they? So a bond is a loan that an investor makes to a company, government, federal agency, or other organisation in exchange for interest payments. This will be over a specified time or period, and at the end of that period of time, the investor will receive a repayment of principal at the bond's maturity date. So in effect, a bond is used by companies and governments to raise finance by borrowing from investors, and there are three basic features of a bond that we need to know about. So firstly, we have the principal. This is the face value of the bond, so the bondholder is repaid their principal in full at the maturity of the bond. Secondly, maturity. So bond maturities can range anywhere from one single day up to 30 years. Now, bonds with a maturity of less than a year are generally called money market instruments. And lastly, coupon. So the coupon is the interest rate that is paid to the bondholder, and the interest is usually fixed and paid either semi-annually or annually. There are a huge variety of bonds, such as corporate bonds, municipal bonds, government bonds, and NS&I bonds, which are the national savings and investment bonds, as you can see here. Now, the NS&I bonds have their advantages because they're backed by HM Treasury, so they offer 100% security for savers, but just like similar bonds of this nature, they don't necessarily offer the highest rate of return for investors. Now, bonds are also rated from AAA class to C class based on their credit worthiness. So AAA bonds are perceived to have little risk of default, and its issuers have a very strong capacity to meet its financial obligations. So let's go through the pros and cons. Investment returns are fixed, so you receive a fixed rate of interest and your principal returned when the bond matures. You know exactly how much your returns are going to be. Bonds are less risky compared to stocks. Besides receiving specified investment returns, bondholders are paid first over shareholders in the event of liquidation. They are also less volatile, so a bond's value can fluctuate according to current interest and inflation rates, but are generally more stable compared to stocks. So let's have a look at some of the cons. So generally speaking, larger sums are required when investing into bonds. So while some bonds can be purchased for as little as, say, £1,000, some bonds might require a larger cash sum up front, which makes them out of reach for some investors. Now, another con is that bonds have direct exposure to interest rate risk. And what we mean by that is that interest rates affect the value of bonds more directly compared to stocks. So if you plan on just receiving interest payments and holding the bond to its maturity date, then you're not going to face as much risk as bondholders who are not going to do that, who are going to be more exposed to interest rate risk. And lastly, investment returns are fixed. So while this offers a higher safety for investors, it's also a disadvantage because you might have had higher potential with your investment elsewhere. Now let's turn our attention to stocks. So here is something that they don't teach you in school. If you want an advantage over most first-time investors, let's start with a few basic principles. So if you want to trade stocks and you want to achieve those higher level returns, you're probably best suited looking at an industry that you know well. For instance, if you are a fellow gamer, then you'll be better placed looking at the gaming industry as opposed to the oil industry, for instance. Now, there'll be plenty of time after you've mastered the basics of investing to learn and invest in different industries, but for now, keep it simple. Another tip, don't let your emotions get in the way of investing. And what do I mean by that? Now, underestimating risks associated with investing is one reason why investors sometimes make suboptimal decisions based on their emotion. So when you buy a company's stock, you're essentially buying a very small piece of that company, and we refer to that small piece as a share. So stocks are essentially a security that represent an ownership share within a company. So for those companies, issuing a stock is a way of raising finance. So a company might issue a stock out to the market in order to raise money and grow, and for investors to then buy one of those stocks. So when an individual owns a stock within a company, they are then known as a shareholder. Now, a shareholder might also be referred to as a stockholder, but there is a difference between a share and a stock. Now, sometimes the terms stock, share and equity are interchangeable in finance terms, but actually each of them represent a slightly different thing. Now, there are many potential advantages of actually owning a stock or share within a company. You might have access to dividends, you might be able to vote, and when you hold stocks or shares within a company, you have limited liability. So if that company was to go bankrupt, for instance, you won't hold any personal liability towards that company as a result. Now, arguably, there are also lots of cons to holding stocks and shares, and some of them include the loss of capital. So the value of that stock is not always going to appreciate in value, it could depreciate, which means that the stock would decrease in value as time goes on, which means that you would ultimately make a loss because what you're able to sell that stock for will be a lot less than what you originally purchased the stock for. Now, in terms of liquidity, so where a business was to go bankrupt, shareholders are not at the very top of the food chain in terms of who's going to be paid first. So if that company was to go bankrupt tomorrow, then the creditors would be paid first over the shareholders. So after money's already gone out of the business to pay the creditors, you may then receive a small amount towards the value of the share that you paid for originally. So ultimately, again, there is a risk that you might make a loss on a share. There are many different factors that affect the value of a share. So it could be anything to do with the global economy, the sector, how that business is doing, any bad press, whether a dividend has just been released, and ultimately how investors feel about the future prospects of that company. So what about intrinsic value? So the intrinsic value is simply the value of the stock based purely on the internal factors inside of that company. And I'll go into that in a little bit more detail in a later video for you. So in terms of stocks and bonds, the biggest difference between the two is that a stock must appreciate in value in order for you to gain profits from that stock, whereas fixed bonds pay interest over time that's fixed. Bonds are generally less risky than stocks, but some investors will diversify their investment portfolio by having a mixture of bonds and stocks across multiple different areas, multiple different sectors, in order to balance that risk between the two and the potential return on their investment. Now, in terms of the savings options available to you, you can always invest into an ISA. So an ISA is an individual savings account. So there's lots of ISAs out there available. And for the financial year of 2021 to 2022, which is from the 6th of April to the 5th of April in any given year, the actual amount that you are able to invest into an ISA is £20,000 without any tax implications. And all that means is that if you were to put £20,000 of your money into ISAs, you wouldn't need to pay any tax on any interest or profits that you earn from those savings and investments there. So if you've enjoyed this video, please do consider subscribing, and if you want to watch more, there will be a link at the end of the video to the next video within this Investing for Beginners playlist.